This is CNN.
Live from the world's financial capital, New York City, this is Business Day with Stuart Varney and Deborah Marchini.
You could say 1995 so far has been a tremendous year for U.S. stocks.
Yeah, you could say that. Since the beginning of January, the Dow Industrials are up 534 points. That's nearly 14%. The Nasdaq Composite has advanced nearly 120 points. That is close to a 16% increase.
So with the markets at such lofty levels, is this a good time for companies to go public? And if they do, should you buy the stock? We spoke recently with three experts on initial public offerings. Robert Natale, new issues analyst at Standard & Poor's, Richard Truesdell, a partner at the law firm Davis, Polk & Wardwell, and Frederick Lipman, author of Going Public and an attorney at Blank, Rome, Comiskey & McCauley.
And we began by asking Robert Natale whether this is indeed a good time to take the IPO route.
It really depends on the industry. If you're a technology company, yes, this is a wonderful time to be going public. But there are actually fewer new issues going on right now than 2 years ago. And that's because there's been a narrowing in leadership overall in the equity markets. Technology is doing very well, but other segments of the stock market, from an industry basis perspective, are not.
The general rule would be that when your industry group is flying very high on the stock market, you come out with IPOs within that industry. That's the way it goes.
Absolutely correct.
Although it's also company by company, because for some companies this may not be the right time to go public. You have to think about what the owner's long-term strategy is. There's a price to going public. You lose control over the company. You've got some independent directors to deal with. It's not quite as flexible. And maybe right now isn't the time in your evolution, your earnings growth, where you can get the biggest bang for your buck.
But from the buyer's point of view, not the company that's going public, but from the buyer's point of view, this would seem to be a rather bad time to go buying those IPOs when the market's an all-time high, isn't it?
Well, the market has actually favored IPOs, and most of them going up this year, with a few exceptions, which have gone down, but most of them have done very well, and you would do very well for at least the first 60 days or so of most IPOs.
That's the perception. I'd like to put that question to Rich, if I may. There is this perception out there that getting your hands on a hot IPO when it goes public is a surefire way to make money. The stock always goes up in the early initial trading. Is that true?
Unfortunately, it's not true, and depending whose perspective you're looking at. From the investor's perspective, often it does go up, although there have been some studies showing that people who can't buy on the initial offering but buy the next day when the stock has doubled in price, long-term, those stocks tend not to perform as well as the stocks that don't pop quite as much at the go-off. From the issuer's perspective, if you're thinking of taking your company public, you have an issue if the stock doubles on the first day. Did you leave too much money on the table? Have you given away too much?
What do brokers, what do underwriters typically do when they price a stock? Is that stock priced so that it will go up in the initial trading?
The target is to have it rise 15 to 20%. That, the theory is, leaves investors happy that they got a modest appreciation, leaves the company happy that the stock is in hands of happy people. If it rises too much, again, they think they've left money on the table. If it falls, you have unhappy investors, and your long-term stock price is going to be hurt.
I'm sure the Boston Chicken people were very unhappy with the pricing of their stocks and said it rose so much, and there was a recent example where a stock within 2 months went from 16 to 50, a Goldman deal.
But there were, in the case of Boston Chicken, there were very few comparables, restaurant chains that were growing as fast as that company, and that makes it difficult for the underwriter to price the deal.
If the underwriter prices it at a discount at the offering price, deliberately so, to see if it can go up in the first few days, are you satisfied with the fairness of the system that allows individual investors to get in at the offering price? I mean, is it a fair system?
Well, that's interesting. I once asked someone from the SEC about that, and he said off the record it's one of the few places where they allow a kind of rigged market, because they do allow a great deal more discretion on the part of the market makers and the underwriters at the time a company goes public than in other moments of trade.
Well, what they do is they favor, most brokers will favor their best customers, and especially if it's a hot issue, they'll make sure those customers get taken care of first.
It's not a flat-out lottery system, is it? It's not first come, first served on a lottery basis. It is a favoritism system.
Right. Well, there are things that are done in the name of efficient markets, and in order to maintain an adequate market, something that's organized, sometimes they have to sell short stock and do things at the time of the offering that they might not be allowed ordinarily to do. And the SEC allows it in the name of maintaining efficient markets. The problem is that you've got a huge sales force force selling a stock in an industry that's hot at the moment. So you've got this concentrated selling effort, a limited number of shares that are being sold at the time a company goes public. 90 days later, the number of shares that are available for sale goes up because the insiders are released from the lockup agreement. Maybe the industry fundamentals aren't as strong as they were in the previous 3 months. And of course, the sales force has moved on to the next IPO, the next stock. So there is tremendous pent-up demand at the time of the offering, and that kind of declines over the course of the following 90 days. The typical new issue underperforms after the first 90 days of trading.
But regardless, it's the public that's benefiting. It's who wins in the public may be an issue, but it's not the insiders, it's not the investment banking community. 20 years ago, the buyers in IPOs were all investment bank officers, employees, etc. Rules have been put in place that on a hot deal they can't buy. So there's an issue as to who in the public is going to win the lottery, but at least it's not an inside game that the investment bankers are the ones taking the profit.
It also depends on when you get in and when you get out. It's no different than the rest of the market. If you get in in the IPO and you wait 2 years, you may in fact be disappointed. If you wait 10 years, you may do very well. It really is a function of buying and selling, and no different than the rest of the market.
But I think you have to make a distinction between reputable underwriters and what I call third-tier or disreputable underwriters. Those with a reputation to protect will have the best interest of the investor in mind. Those that don't have a reputation to protect may manipulate shares in the aftermarket to the disadvantage of the people that they put into the
well, there's legal manipulation. I mean, manipulation basically is stabilization, and the underwriter is legally permitted to stabilize the price to permit the distribution. SEC rules permit that.
There have been many instances in which an underwriter, a third-tier underwriter, will say, I can get you 1,000 shares of this stock if you agree to buy 1,000 shares afterwards. All right, they orchestrate. They're the only market maker. There's nobody else really concentrating on the stock. They know where the stock has been placed.
Really briefly, is this an area ripe for more regulation?
I think the SEC is always looking at the IPO market.
But the considerations now are actually deregulation. There's been proposals now of sort of a one-time registration, and then instead of each time having to go through with the process with the SEC, you'd be free to do deals from time to time.
The system that we've got, you kind of like it and don't want to see fundamental change?
This has been a wonderful way to raise money. I mean, the
and
U.S.
to cash out your own private company,
That's
too.
true, but the U.S., I think, has been absolutely outstanding in creating an environment to bring companies public and to raise capital in the right parts of the economy. And the new issues market has been very successful in doing just that. I don't think the SEC wants to tinker too much with that.
As a matter of fact, companies come from all over the world to sell in the U.S. market. It's considered the best in the world, and there are problems with it, but every time you tinker with it, sometimes it gets worse.
Extraordinary. We've achieved consensus. And we're out of time. Gentlemen, many thanks indeed. I'd like to thank our guests indeed. Robert Natali, a new issues analyst at Standard & Poor's, and Richard Truesdell, a partner at the law firm of Davis Polk and Wardell, and Frederick Lipman, author of Going Public and an attorney at the Philadelphia law firm of Blank, Rome, Comiskey, and Macaulay. Gentlemen, many thanks for being with us.
Thank you.
Thank you.